Hey everyone, welcome to the channel. We all love a good sale, right? Well, guess what? The stock market is having one right now. It's not all sunshine and rainbows on Wall Street. While some stocks are hitting all-time highs, others are taking a serious dip. And when I say dip, I mean some of these companies have fallen off a cliff compared to where they were just 6 months ago. But here's the thing, a dip doesn't always mean a disaster. In fact, it could be a prime opportunity to snag some amazing deals on companies you've had your eye on. So, are these discounted stocks hidden gems just waiting to be scooped up? Or are they ticking time bombs ready to explode your portfolio? That's what we're diving into today. We're breaking down 5 popular stocks that have taken a tumble, figuring out why they're down, and most importantly, deciding if it's time to hit that buy button or run for the hills. Let's get started. Alright, let's jump right in with the biggest loser on our list. And honestly, this one surprised me. Elf Beauty, ticker symbol ELF, is down a whopping 42.35% in the last 6 months. Yeah, you heard that right, almost cut in half. This was the darling of the makeup world not too long ago, known for its affordable yet high-quality products. So what went wrong? Well, a couple of things. Remember those things called tariffs? Well, Wall Street has been anticipating they would have a negative impact on ELF ever since Trump got elected. And then there's the whole inflation thing. People are expected to cut back on spending, and those cute little eyeshadow palettes aren't exactly essential items. But here's the question, is this a temporary setback or a sign of things to come? ELF is still a powerhouse in the affordable makeup market, and their online presence is huge. Plus, they've been expanding into skincare, which could be a game changer. Personally, I'm not hesitant at all to jump on this deal. ELF has been a premium company, and they should be positioned well to handle these issues. We will see what their next earnings report looks like. I'm not waiting on this dip, and even better if it turns into a full-blown crash landing. Next up is a company that's near and dear to any tech lover's heart. Advanced Micro Devices, better known as AMD. This semiconductor giant has been absolutely killing it in recent years, going head-to-head with Intel and even stealing some market share. But even giants stumble, and AMD has fallen 25.34% in the past 6 months. So why is a company that makes the brains of our computers suddenly feeling the heat? Well, the entire chip industry is going through a bit of a rough patch right now. Remember that global chip shortage? Yeah, it's still a thing, and it's messing with everyone's production. On top of that, the demand for PCs has cooled down from its pandemic high. Remember when everyone and their grandma was buying laptops for work and school from home? Those days are kind of over. But hold on, before you hit the panic button, let's remember who we're talking about here. AMD is a leader in innovation, and they're not just in the PC game anymore. They're making waves in data centers, gaming consoles, and even electric vehicles. This could be a classic case of short-term pain for long-term gain. I'm keeping a close eye on AMD, and if they keep innovating like they have been, this dip is a fantastic buying opportunity. Alright, let's move from the tech world to something a little more, well, concrete. Toll Brothers, one of the biggest names in luxury home building, has seen its stock price tumble 21.26% in the past 6 months. So what's got this construction giant feeling down in the dumps? In a word, mortgages. Remember those super low interest rates that had everyone rushing to buy houses? Yeah, those days are long gone. The Federal Reserve had to raise interest rates like crazy to fight inflation, and that means mortgages are way more expensive now. And when people have to shell out more cash each month just to pay their mortgage, guess what they're not buying? That's right, fancy new McMansions. The luxury housing market is feeling the pinch, and Toll Brothers is taking the hit. But here's the thing about Toll Brothers, they cater to a very specific clientele. Folks who aren't as affected by things like, recessions. These are people with money to spend, and while they might be a little more hesitant to buy right now, they're not suddenly going to start shopping for studio apartments. I'm cautiously optimistic about Toll Brothers. If you believe like I do that the housing market will rebound eventually, then this could be a good time to buy in at a discount. But be prepared to hold on to this one for a while. The luxury housing market is cyclical, and while it may be down now, history shows it tends to bounce back. So, if you have the patience and the capital, this could be a strategic move. Investing in luxury real estate often requires a long-term perspective, but the rewards can be substantial. So, keep an eye on the market trends and be ready to act when the time is right. Next up, we have a company that knows a thing or two about luxury, Estée Lauder. This beauty giant owns a whole portfolio of high-end brands, from Clinique to MAC to La Mer. These brands are synonymous with luxury and quality, often setting the trends in the beauty industry. But even with all that glamour, Estée Lauder has seen its stock drop 16.22% in the last 6 months. This decline has raised eyebrows among investors and market analysts alike. So, What's got this beauty queen feeling a little less fabulous these days? The answer isn't straightforward, but several factors are at play. Well, remember how we were talking about people cutting back on spending because of inflation? Rising prices are making consumers more cautious about their discretionary spending. Yeah, that's hitting the luxury market pretty hard. High-end products are often the first to be reconsidered when budgets tighten. That $50 lipstick suddenly seems a lot less appealing when you're worried about your grocery bill. Consumers are prioritizing essentials over luxury items, and then there's the whole China situation. The impact of the tariffs and subsequent inflation cannot be underestimated. China is a huge market for luxury goods. Estee Lauder was counting on China to drive growth, and that just hasn't happened. The anticipated recovery in this key market has been slower than expected, but let's be real. Estee Lauder has been around for decades and they've weathered plenty of storms. Their legacy and brand loyalty are strong. People still love their products, and the demand for luxury beauty isn't going away anytime soon. The allure of high-quality beauty products remains. This feels like a classic case of a solid company facing some temporary headwinds. Market conditions may be tough now, but resilience is key. I'm not hitting the panic button on Estee Lauder just yet. The company's fundamentals are strong and they have a history of bouncing back. In fact, this dip could be a chance to add a little luxury to your portfolio at a discount. For savvy investors, this might be an opportunity worth considering. Last but not least, let's talk about a company that's all about energy. Celsius Holdings, the maker of those trendy Celsius energy drinks. This brand has been making waves in the health and fitness community, promising not just a caffeine boost but also a healthier lifestyle. You've seen them everywhere, from gyms to grocery stores, and for a while there it seemed like everyone was chugging them down. Their sleek cans and vibrant marketing have made them a staple in the energy drink aisle. But even with all that buzz, Celsius has seen its stock price fizzle, dropping 14.3% in the past 6 months. This decline has raised eyebrows among investors who were once bullish on the stock. So, what's got this energy drink giant feeling a little sluggish? Is it just a temporary setback, or is there something more concerning at play? The energy drink market is cutthroat, and Celsius is facing some serious heat from rivals like Bang Energy and even good old-fashioned coffee. The market is saturated and standing out is becoming increasingly difficult. It's tough to stay on top in this game, and Celsius is learning that the hard way. The pressure to innovate and stay relevant is immense. On top of that, there have been some concerns about Celsius's marketing tactics. Their aggressive advertising strategies have come under scrutiny. They've been accused of making some pretty bold claims about their drink's health benefits, and that kind of scrutiny can make investors nervous. When a company's claims are questioned, it can shake consumer trust and investor confidence. But let's be real. Celsius has tapped into something big. Their focus on health and fitness resonates with a growing demographic. People are looking for healthier alternatives to sugary sodas, and Celsius has positioned itself as a fitness-focused brand. This niche market could be their saving grace. I'm on the fence about this one. The potential is there, but so are the risks. On the one hand, I love their product, and I think they have a lot of potential. Their innovative approach and strong brand identity are impressive. On the other hand, the competition is fierce, and those marketing concerns are a bit of a red flag. Only time will tell if Celsius can maintain its momentum, or if it will fizzle out in the face of these challenges. So there you have it, 5 popular stocks that are all on sale right now. Remember, a dip in price doesn't always mean a company is doomed. It could be a fantastic opportunity to buy into a great business at a discount. But it's up to you to do your research and decide if these falling stocks are hidden gems or potential disasters. Think about their long-term prospects, their management team, and whether you believe in their future. What do you think about these 5 companies? Are you buying the dip, or are you staying far, far away? Let me know in the comments below. And don't forget to like this video, subscribe to my channel, and hit that notification bell so you never miss an update. See you in the next one.